I'm joined now by Pascal Duval. He is the CEO of the EMEA region for Russell Investments. Pascal, there's a lot of market volatility out there at the moment. Is it the job of investors to just learn to live with it, or is it your job as a product provider to smooth returns to them?
Well, unfortunately, I think we won't be able to smooth it for them, so we have to live with it. And yes, definitely. So if investors want to get a little bit of return, and there is some return to be earned, we have to live with volatility. We need to see volatility as an ally to return, and not as an enemy to return anymore.
And we're in this world where a lot of commentators say that asset prices are very rich, but there's no or very little global economic growth out there. How do you generate returns?
Well, very good question. Well, precisely the only way to generate return is to actually take on and embrace volatility, but you have to manage it very dynamically. So that means you have to switch asset classes depending on where they are on their patterns and different valuations levels. So for example, emerging markets, we believe they are extremely well valued today, but there's very strong fundamental against them, so we won't be there. But if the fundamental get there, we will go into emerging markets. So we're underweight today, we might go overweight in 2 or 3 months' time from now.
But I suppose the next part is not just how do you try and generate returns, but can you justify fee levels in a world where markets, are particularly bonds, producing negative returns?
Well, that's a very good question. You know, we made an analysis and we found that a striking number, about 75% of bond funds, government bond funds, have yields below TER, below the yields of the government bonds. So definitely, again, here you'll have to go for some diversification, asset allocation moves, and go for higher yields to be able to overcome the fees and deliver a positive yield for the clients.
But do you worry at all that perhaps there's almost a bubble in alternatives to fixed income brewing?
Yes, I think they are. They're not very much with institutional investors, because we know institutional investors are pretty long-term and they will stay pretty long-term. But with retail investors, which have provided most of the stimuli into cash flows in fixed income funds over the last 5 or 6 years, yes, there might be a liquidity crisis if suddenly there's a plunge of on the returns of those funds. So definitely asset managers have taken and should take measures around potential liquidity crisis linked to daily NAV funds going into deep redemptions.
And are there any other big risks out there that you think investors on the whole are a little bit flippant about, maybe not pricing correctly?
Not so much. I think the markets are pretty well priced in terms of risk over it. The big question is what you were saying earlier, is that investors have to live with the risk, and we have to make sure that they understand that. And to make it successful, you need a dynamic asset allocation and a dynamic review of your portfolios.
Final question. As you look out across the markets at the moment, what do you see that gives you hope? What is there some piece of innovation, something that you think is going to be really important in the markets next time?
Actually, I'm a little bit more worried than that, because I'm worried about the growth of the robo-advisory concept. I can see, we can see all the benefit of the concept, but to think that robo-advice will plug a deficit on advice and will deliver advice to people who can't get advice through financial advisors, I think this is a wrong thing. A robo will never deliver advice, customized advice. So actually, I'm on the opposite. Not think something exciting. I see something a little bit worrying.
Exciting, but in a bad way.
Yeah, exactly.
We have to leave it there. Pascal Duval, thank you.
You're welcome. Thank you very much.